There's a lot of Fed speak about this, and it's no surprise. Inflation is a big problem, and it affects everybody, disproportionately so middle income and lower income Americans. That's the reason why it's a big deal. But you have a lot of CEOs, a lot of banker Wall Street types saying that maybe inflation has already peaked. So what exactly is the Fed's next move?
Well, I think we are going to see, much like Wall Street is predicting, so that we're going to see certainly a lower pace. And, you know, for those that are saying it's looked like a peak, it has been in a steady decline since June, or you know, a fairly steady decline. It's just we can't get it down fast enough is the real issue. And I think right now we're also struggling with the fears of inflation, which obviously hits Americans in their pocketbook, versus recession, which can also hit Americans very hard. And so those fears between inflation and recession and interest rates are really what's sort of struggling and keeping this market very focused on the macro effects, rather than fundamentals and what companies are expected to perform over the next few months or even year.
Oh, I mean, Aaron, we've turned to you in the past a lot over the last several years to talk about some of those corporate fundamentals, the earnings picture. We're early in the earnings season right now, but things don't look terrible. They're not off to the races by any means whatsoever. But is this a scenario where earnings growth is still at risk, or are we just talking ourselves into a recession? What are the corporate results looking like right now to you?
So certainly, obviously, for fourth quarter, they look fine. But obviously, that's in the past, and we're really concerned about what are they going to do the first 2 quarters of this year. And right now, the expectations are really coming down. And that's normal that expectations come down at the beginning of earnings season, but they've really been coming down. And they've dropped to a little over 3%. For the entire year, mostly because we have so much pessimism around how companies are basically going to contract, not grow, for the first half of the year. And so that's why there's just a lot of concerns about how hard this recession, or if there is a recession, if it's going to be, how long it's going to last, and how the Fed's going to manage to, or hopefully be able to pull us out. And so right now, basically all the hope when it comes to fundamentals is a little bit in the third quarter, but almost all of the growth is expected in the fourth quarter. So right now, Wall Street's just going to say it's going to be really bad for the first 3 quarters, but we're going to get out of it by the fourth. And that's the hope that certainly by the end of the year we'll be somewhere in a much better position and in a very positive place.
So Aaron, you're not the only one who feels that way. That there seems to be a growing consensus that it's going to be like a tale of two markets. There's a 1H first half of the year and then a 2H, second half of the year type thing where things get better. With that being said, what exactly is the opportunity? Is it here in the U.S.? Is it value over growth? Is it tech, or is it energy? Is it international versus domestic? What exactly is the theme here, and how should you position?
Yeah, so right now, I think we're still in this, I think we're going to be in a continually highly macro environment where the broad market and the broad indices are very much dominated around headlines over inflation, employment, that type of thing. There are a few industries that really are standouts, just like we had energy last year that really broke the trends. I think there are a few industries this year that are also going to be able to break those trends based off just as exceptional earnings. And one area in particular are resorts, travel, those types of entertainment and leisure companies. They really have stellar outlooks. In the U.S., they're expecting about 130% profit growth for the year. No quarters of contraction at all. And it has so far been one area that consumers are willing to spend. And on top of that story is European travel and leisure, and also luxury brands are also been done very, very well since the beginning of the year, have been outperforming their peers. And even though Europe is still expected to grow more slowly than the U.S., there are those pockets that just have amazing outlooks, very stable earnings, have been beating their estimates, and are really good plays off of the reopening of China, a stronger euro versus a dollar, and just improved expectations for Europe. They were just so dismal,
Sure.
and valuations were so low. That's another thing that's going for them, and I think that's one area to look at for the next 6 months until we feel really confident about the U.S.